How for you did it move the dial as an investor?
I think the message of from the government report is quite important, and I'm quite impressed by the several points from this report. First one, you can see the growth target for 2021 has been set 6% above, which is actually relatively low compared with our prediction. But by this growth, you can see China want to seek for, it's not just level growth, but more importantly is the quality of the growth. And secondly, I think if you look at the message of the report, they're trying to emphasize the innovation. Innovation for China is very important at this stage. And thirdly, I think the message from this report, you can see that they try to boost domestic demand, especially consumption. I think that's quite important in this 14th five-year plan period. And lastly, I think is something also quite important is the green development. China has promised to, to reach so-called carbon neutrality by 2060. And I think in this 14th five-year plan period, China will take more measures to reach, to prepare for reaching such a kind of target. So all these kind of messages are have mid-term and long-term implications for investors. I think that should be, I think over the next few months and even over the next few years, people may try to read these messages for investment in China.
Did you find anything new, something appear new that you hadn't been flagged up before this meeting?
I think there are several points actually. As I mentioned earlier, I think the growth target is actually lower than my expectation. As CICC, if you look at the CICC research, we forecast 8 to 9% GDP growth for 2021 for China, while the growth target for the government is like 6%. I think this is a bit lower than we expect, but I think it's understandable because the overall target for China is now is not only the level of growth but also the quality of growth. And secondly, if you look at the policy, given the growth may continue to be rather robust in 2021 for China, the abnormal policy support we have seen last year will gradually phase out this year. So you can see in this government working report, one of the message is that they gradually phase out this policy support. For example, if you look at the fiscal deficit as percentage of GDP, the target for this year is only like 3.2%. I think is significantly lower than what we see last year, which is something like 6.3%, 3.6%. So essentially, in the short term, I think China, with the growth gradually recover, China want to phase out this additional policy support. And I think another point quite impressed me is the emphasis on structural issues, especially like the technology improvement, and also they are focused on the environmental protection, and also like this the input for innovation and education, and the research and development expenditures. This kind of indicators, I think they show what the government care about is not just the level growth, but also the quality of growth. They are seeking for a more balanced growth, more sustainable growth, and high quality growth.
So Hanfeng, having said that, how do you position yourself to perhaps optimize the gains from the Chinese market in the next 5 years?
I think that's a very good question, especially given China is just is going to release the full content of this 14th five-year plan. In 5 years, I think China will continue to transit the economy from a more investment-led growth model to a more consumption-based model. So I think this consumption and the service and tech and also advanced manufacturers, these kind of areas will continue to present very good long-term secular growth opportunities for the investors in China and also investors from the globe. And
also, last few days, we've seen a sell-off. Over the last few days, Hanfeng, we've seen a sell-off in stocks deemed frothy. Do you expect that to persist?
Yes, they may persist for a while. Actually, we have, as a strategist, actually have reminded investors from early February this year that the market volatility may increase because you can see there are several factors. Number one, the market bottomed out since March 23rd last year, and it had a very long and a very big bullish run. Secondly, you can see the valuation. If you look at the A-share CSI 300 index, before this correction, the CSI valuation has already reached the level close to the peak we have seen in middle of 2015. And thirdly, I think China's recovery has reached a level we have seen before the pandemic. And that means the recovery has to quite a degree, and the further improvement may be quite limited. And on the margin, you can see China is gradually tightening the policies. They gradually phase out the policy support we have seen last year. So given all these conditions, valuation is a little bit rich, performance has been so good, and growth may continue to improve, but with limited room. And also, the policy are changing on the margin. So I think it's natural to predict the market may consolidate